Investors Chronicle.
Welcome back to the Companies and Markets podcast. It is Thursday, 12th of January, 2023. Delighted to welcome Val Cipriani back to the pod for the first time this year. Hi, Val.
Hi, how you doing?
Very good. Good to have you with us. Alex Newman's in the studio. Hello, Alex.
Hello, John.
And we've got Mark over the line. Hi, Mark.
Good morning, John.
Good afternoon, I think you'll find, Mark. And Julian as well. Hi, Julian.
Hello, John.
And then Dan Jones hosting. Dan, what's coming up today?
Hi, John. Yeah, a few things today as usual. We start with Direct Line. Pretty disappointing trading update yesterday, so we're going to dig into that a little bit. Then we are going to discuss a platform issue, specifically some of the proactive moves that Fidelity have been taking on their platform in relation to what retail investors can and can't do. And finally, we are going to talk a little bit about China and some structural changes there in terms of supply chains and companies maybe rethinking their approach to China, and also a little bit about reopening as it scraps its zero COVID policies.
Lovely stuff. Well, let's have a look at some company movers and shakers just before we get to that. First up, UK pharma giant AstraZeneca has spent £1.5 billion to acquire US biotech firm Syncor. The company specialises in a drug to treat high blood pressure. Microsoft are discussing an investment in the latest artificial intelligence phenomena, ChatGPT. They are reportedly looking to buy a third of ChatGPT owner OpenAI to the tune of around $10 billion. Shares in Robert Walters fell 8% on Tuesday morning after the recruiter said that full-year profits would fall below market expectations. Competitor Page Group also took a 6% hit. And the newspaper publisher Reach fell 25% on Wednesday after the group announced its annual operating profit would underperform expectations. House builders, Barratt fell 3% after revealing a 44% slump in sales. Persimmon, on the other hand, saw shares up 7% despite private sales nosediving to end 2022. The Irish house building landscape is proving more fruitful, with Cairn jumping 4% on a 46% rise in revenue. Online fashion retailer ASOS shares jumped 19% this Thursday morning after a, quote, significant improvement in profitability and cash generation. That's despite sales falling in the 4 month to December 31st. And British gas owner Centrica has said its 2022 earnings would be 7 times higher than in 2021. With Centrica operating as both a retailer and a wholesaler, they've managed to effectively capture the profits offered to gas companies by the ongoing energy crisis. And finally, there were solid Christmas updates from supermarkets Sainsbury's, Tesco's and Marks and Spencer's, with consumers apparently not put off their turkey, sprouts and cranberry sauce yet by inflation. Lots more as ever on our website and in the magazine. But for now, the rest of the show with you, Dan.
Thanks, John. Yeah, there's a raft of trading updates around today, and the going is pretty good to firm, I guess, as they say. Retail continues its theme of beating muted expectations. Centrica has raised guidance. Even Persimmon, which hasn't put out great figures, has had a bit of a relief rally. So things are looking okay, but we are going to talk about one of the black marks of the week, which is Direct Line. Certainly the biggest disappointment, I think, its trading update out on Wednesday. Cold weather and claims inflation mean it scrapped its final dividend. More to the point, this is quite a big turnaround from what the company was saying just a few weeks ago in November. Julian, you looked at the trading update. Your thoughts?
It was certainly very disappointing, Dan. The problem the company has is that you can't really put your finger on one single reason why they consistently underperform. So one of the reasons was, as you said, the cold weather. So more burst pipes, more cars sliding on ice into each other's garages, and the replacement for all that costing a lot more money because parts prices have gone up. But I mean, that's kind of the same for all of the motor insurers. And the mystery really is why it's hit Direct Line specifically so hard, and why the markets reacted so badly to it. I mean, part of that, I think, is that investors were very cautious of what the management says these days, because it was only 8 weeks ago that they were saying that things were generally okay, and they were keep their earnings online and things like that. And now the investors are looking at dividend cut, and one of the primary reasons of owning Direct Line was that it always had quite a high dividend yield that income investors could more or less rely on, and in many ways that was its only attraction. It's been a sort of consistent value trap for many years. I mean, you have to go back to 2014 or something, not long after the Scottish Bank, as the more superstitious of us like to call it, divested the company. Ever since that point, really, the shares have never had a hope of getting back to the 410p they were in November 2015. And the reputation as something that you just held for income and just hoped for the best in terms of the share price has been there for quite a while. But I mean, this down leg, it is indicative of I think a multitude of small problems all coming together at the same time for them. It's a very disappointing company in many ways, but I don't know. I mean, I don't know what other people's view is, but I've never found them very convincing.
It seems rather odd to me anyway that provision for these aren't even catastrophic losses, one imagines, but you would think these type of potential losses would be covered in their underwriting policies anyway. This all boils down to solvency ultimately as well, and it would be reasonable to assume that they've been inadequate from that perspective as well. The fact that they had a prospective yield of around 10% should have been as much of a red flag as an attraction for investors too. But it seems very peculiar to me that a general insurance company would be sort of
I mean, they're not small. I mean, there's the second biggest in the country. I mean, admittedly, a relatively distant second to Admiral, but they've still got 11% of the market. And I mean, I looked at this with a bit more depth, and it seems to me like there, underneath the surface of the company, there's a lot been going on in the last couple of years, and a lot of people have been moving and leaving, and responsibilities have been handed out in different ways. The chief operating officer left in 2021; he wasn't replaced. So if some advice for our listeners: if you want to plan a military coup, you don't go to the generals; you always go to the colonels. It's always the people in the second rank who know how the business works, and they count the paper clips and make sure everything's working. And you do wonder whether the number of changes they've made have actually contributed to their issues in terms of keeping on top of their underwriting and making sure that the market they're not so exposed in any one area. But clearly something's gone wrong.
We'll come on to the wider insurance market in a second, but I just wanted to return to the high yield that you mentioned. And Mark, as you said, that maybe that should have been a warning sign. But Alex, we did include Direct Line in our list of high yielders last week. There's a potential risk there, but that risk has manifested itself very quickly. And in a surprising fashion with the full year dividend cut.
Yeah, so we included it in one of our 5 portfolios of in the ideas of the year, and the yield was very high, but I think the consensus forecast was for it to be cut, not for it to be abandoned as it has been by management following this update. But when you're looking kind of above sort of 8%, you're getting into potentially danger territory. I mean, things have changed a little bit now, given where inflation is and what income investors are asking for. The fact that it has been, it's as Julian said, its kind of income case has been the reason to hold it, was a reason why we decided to include it in the portfolio. I sort of agree with Julian as well that this is quite a sort of sudden and extreme move. I mean, the charitable view is that the weather was really extreme and unexpected, but the less charitable view is that the management just really telegraphed this very, very poorly. The Goldilocks of insurance underwriting is very, very hard to achieve, to make a profit in something which is so commoditized as driving insurance or home insurance. Something has gone wrong here. Really, they've slipped up, not been able to forecast it, even though 8 weeks ago things were looking in a reasonable position. The income case is certainly gone now for this year at least.
Well, they,
or for 2022 at least.
Yeah,
I should say.
they do say they, as it stands, they intend to pay a full dividend for 2023, which obviously, we'll see how that pans out, because it does seem, the cost inflation, aside from the cold weather issue, the cost inflation is proving problematic. Premiums, well, certainly in the third quarter, they didn't give an update on the fourth quarter and this metric, but premiums have been falling faster than volumes, which suggests, they haven't been able to pass on costs that well. There's a lot of competition in the market, obviously. I think maybe it's also notable this week the FCA suggested, is putting a bit of pressure on insurers to waive some fees for vulnerable customers, which again calls into question the pricing power. We did see a bit of a reaction from the sector in general, whether it was to the FCA, whether it was to Direct Line, probably more of the latter, but a bit of both. So I wonder if there's more of a read across for the sector as well, Julian, aside from, Direct Line's issues it has internally in terms of the sector's ability to deal with a high inflation environment.
Yeah, I mean, that is the $1 million question. I mean, they've had a lot of regulatory hits. I mean, you're right that the FCA has been after them for about these particular type of vulnerability fees, but the more significant one was the end of what everyone calls price walking, which is where they could basically charge existing customers a above inflation rate every year for loyalty, effectively. And that's caused the general insurers particularly problems because the market is so competitive that there's only so much leeway they have in pricing in terms of acquiring new customers. And you think that kind of leads you to think that part of the problem would have been that they've been over underwriting or overwriting the book in order to make up for that, which is why they kind of have been particularly hit particularly hard. But it is an issue for everyone. But the mystery is why it's such an issue for Direct Line when the likes of Admiral and Aviva, who have a certain amount of presence in this market, don't seem to, although their shares have fallen, they don't seem to have been hit anywhere near as hard. But I mean, we have to wait for their trading updates probably to see if there's any read across.
Well, I suppose with Direct Line, if they are pinning it all on the weather and a difficult December, given it's been quite a mild January, might be a mild February, we should be expecting much better things from them in a few months' time. But
we're probably going to hurricane season.
Well, yeah.
Just one point down as well. I just wonder how much of this is related to the disruption that occurred because of the pandemic as well, because claim rates were extremely low during that period as well. And as we all know, that's a chief determinant in future premium rates too. So perhaps they're coming under the wire simply because of the lag from COVID. I don't know if that's the case, but it'd be worth examining.
Something to consider there. Well, let's move on to the next section. Nonetheless, we are going to talk about Fidelity now, the platform which some of our listeners may use for their investments. And they've been in the news this month because they have suspended investor access to Jupiter UK mid-cap. The company hasn't provided an explanation. The fund does have some unlisted holdings, and like many mid-cap funds, it's had a pretty tough time of it, which means as the listed holdings fall as a percentage of the portfolio, the unquoted proportion rises. It's been getting quite close to the 10% limit. So there's concerns there over liquidity risk and what happens if it breaches that limit. So you would suspect that's the motivation behind Fidelity's decision. Although, like I said, they haven't actually provided any reasoning on the website, which is interesting in itself. And it's also interesting, Val, you've written about that this week, that a platform, an execution-only platform, is doing this. It is taking decisions on behalf of its customers regarding what funds they can access in this case.
Yeah. Basically, that's what they're doing. And as you say, they only say they believe this is in the best interest of the clients, but they do not explain what their thinking is, which potentially some experienced investors might find a bit confusing and jarring because, as you say, they cannot have any new investments in the fund, although they can obviously sell their shares, whereas advisors are still kind of at liberty to do what they want on the advised side of the Fidelity platform. It kind of generates some questions, doesn't it? Because so other platforms for now, it doesn't look like they're doing the same thing. So for example, AJ Bell told us that for now they have no plan to do so, and the fund is still available on Hargreaves Lansdowne. Hargreaves has like a sort of a different strategy because they've got a little notification on top that kind of leads you to the research that they've done and that tells you why they're worried about the fund, but it doesn't stop you from investing into it if you want, or if you want to take a contrarian view. Yeah, and so I guess the question is why is this platform kind of telling people what they can and cannot do with their money, especially because, it's not like a gentle nudge, like you shouldn't invest in this fund. It's more like you absolutely cannot, sorry. If you want to, you're going to have to go somewhere else. Fidelity is also not new to this because it's done something similar last year, like in 2022, although it seems for different reasons because they haven't explained it. But again, they stopped new investments into 3 other funds. And there were reports that it might have been because they breached like a charges threshold that they had set internally and unofficially. And again, Fidelity did not confirm this. And again, one might think, well, if you're going to stop me from investing in something, I would at least want to know why you're doing that. There is also kind of an argument in favor of what they're doing, which is obviously the kind of like protection of investors who might not be as experienced or might not follow the news as closely and might not know what potentially is the problem with this fund. And this seems to have quite a bit to do with what the Financial Conduct Authority is doing, because the consumer duty rules, which are expected to come into effect in July this year, so 2023, they say that basically they kind of need to take a bit of responsibility and make sure that a product, so in this case a fund, provides fair value to customers, and they sort of should make sure that they address any risks to good customer outcomes, they say. So for now, the other platforms are not doing the same thing as Fidelity is, but there is a bit of a question in terms of whether they will need to do it at some point, or kind of like take a clearer stance on this kind of thing.
Yeah, as you say, it does seem potentially partly regulation driven. The FCA has been keen on platforms to do more for their customers, but protecting inexperienced investors is certainly a laudable aim. But as you say, when you have a large selection of different types of retail investors, you're to some extent the more experienced ones who might be wanting to take a play on an out of favour funder will fall victim to the need to protect the inexperienced ones. And the other question, I suppose, is where do you draw the line on these issues? They have again, reportedly, if they have an internal charges threshold, if they have, they're starting to worry about certain funds like this fund, what other funds might they be worried about? Who makes that decision? When is that decision made? How do they judge these things? It's all, it's difficult to, I imagine in most cases, people won't know until they're prevented from investing in the fund. And as you say, it is just very different from what retail investors have come to expect from their platform. Normally, it's not like you're working with an advisor or even a stockbroker, old-fashioned style, if you want to say old-fashioned, is very much, transactional platform, isn't it? Or it has been in the past. So this is quite different. And yeah, I find it quite interesting to see whether regulation will push more people in that direction.
Yeah, it is, kind of a bit unexpected, isn't it? And then there's platforms tend to have like research and analysts, so they will nudge customers a little bit, like try to help them make the right choices. But yeah, as you say, it's not the same thing at all from stopping them from investing in something. And again, without having clear criteria on when that that they're going to do that.
I was going to say, one of the problems this has thrown up is that, it's left us and, potential investors affected by this just to speculate, because until they explain why they're doing it, that's all we can do. And I was actually, for my sins, I was looking through the consumer duty legislation to try and get a handle on if Fidelity has interpreted those rules to mean that they need to gate certain funds. And that may be the case. They may have just arrived at that conclusion. But there is also part of the consumer duty legislation. It's quite complicated. And I think it's a bit vague as well. But they talk about where consumers can only be expected to take responsibility where firms' communications enable them to understand their products. So this is about this consumer understanding part of the rule. And if you're not giving an explanation as to why you're doing it, then it doesn't really give a full account of the risks. And I don't really know how that it fits in with their interpretation of these rules coming down the track. But
this is quite common from my of time in the past covering various FCA documents in the past. By the nature, they have to be everything to everyone, and that does mean a lot of the regulation is broad and it is open to interpretation, and that means you're left with companies doing things in different ways and each of them hoping that they're not going to be the ones that fall foul of the regulator, and of course you'll get some who are playing it safer. I mean, again, this is speculation. It may be nothing at all to do with regulation. It may be Fidelity have decided that's what they need to do in general. I'm sure the shadow of Woodford hangs over these things, and they might think, well, if this does happen, this will be a big PR win for us. If we say, we stopped investors investing in this fund months ago, and everyone else is stuck in it. Anyway, for the final section of the show, we're going to go very much more macro. We're going to look at China. Mark, you have written about China this week in the magazine, focusing on, to some extent, suppliers and supply chains and companies moving production away from China. There's been a few examples of this recently. This morning, in fact, Nikkei, our sister publication, has reported that Dell and perhaps HP are also looking to move production away from China, or at least diversify their sources of production. So it does seem to be a bit of an emerging trend, certainly over the last year, and maybe one that will continue this year as well.
Yeah, there are a number of reasons for this as well. I think it's worth remembering that there were major changes to supply chain management even prior to the pandemic as well, and before any political considerations linked to China. And that was largely because of the general digital transformation. Companies were looking at the cost benefits that could be generated from this, and I guess that, to an extent, that makes the cost benefits companies can gain from basing production, some of their or all of their production in China. It mitigates it to a certain extent, and that was already happening. And the onus now is on building resilience into supply chains. So the considerations linked to production costs and the size of China's domestic market have gone down the pecking order a little bit. There's obviously a security issue linked to this as well. For instance, the US government has explicitly stated that they're targeting China's semiconductor production capacity and capabilities as well. And that's a geopolitical move to try and offset their progress in other areas. But of course, the Chinese sort of lead the world in reverse engineering. So how successful that will be, I don't know. But on that score as well, that sort of heightens the tensions over Taiwan as well, because obviously Taiwan is the preeminent semiconductor manufacturer in the world. And doubtless Beijing have been looking on at Taiwan as well from a strategic angle as much as anything else. And a lot of the moves that we're seeing now are in fact linked to geopolitics rather than those narrow considerations over production costs and the size of China's domestic market. So it'll be interesting to see over the coming months if that trend, if a trend has been firmly established.
Yeah, as you say, the CHIPS Act in the US does seem to be a big driver at the moment. The companies who have been reported to be moving production, they are, a lot of them are tech or even chip based, and much like the US Inflation Act, there does seem to be a piece of legislation that is having real observable impacts on how companies do business. As you say, there is a pre-pandemic and also pandemic effect as well. Obviously, supply chains have been struggling for a long time now, not helped in recent months by various lockdowns continuing to occur in China. Of course, that seemingly has all rapidly faded away. We've got a China reopening now, which I think could be a real massive kind of boom this year for various sectors. I think we were talking earlier, away from the podcast, but just about, the impact on the commodities complex, potentially the impact on tourism around the world. If you get Chinese tourists, that pent-up demand we've seen in the US, UK, coming from China in much bigger numbers.
Luxury goods,
exactly.
Aviation volumes. I mean, you name it.
So that could be in the short term. That could be a counterweight, I suppose, in some ways, where companies think, well, actually, we're going to get some decent production from our Chinese factory, and some, for the first time in a while, and we're actually going to, maybe benefit from pickup in demand as well from China for those companies who benefit from that. So it's another thing to consider, I suppose.
And from last year as well, for an 18-month period, 18 months to 2-year period, China had pursued a sort of non-interventionist policy in regards to some of their large internal markets. Most notably the real estate market, although that turned out to be something of a fudge, really. But now central government policy is targeting infrastructure development and also the expansion of China's domestic retail market too. On that first point, is there, that's infrastructure development was one of the main reasons why China's economy developed as quickly as it did, or return those incredible growth rates over a 20-year period, really. But I'm just thinking into Japan's example when during the 80s and 90s, when they were pushing massive infrastructure spending internally there, and it didn't really have the desired effect in terms of growth rates. So I don't know if that's going to play out in China. China's economy is much larger. You're not going to get those 10% growth rates anymore just through the fact that it's coming on proportionally. You're never going to get that again, or I doubt it very much. But what it will do as well, it will boost up prices within, or underpin prices within the commodity sector going forward too. But we just are awaiting a little bit of detail on that front.
Mm. I suppose the political side of things is maybe another reason why companies might be reconsidering their investments there. Even on the reopening side, the fact that, okay, from a corporate point of view, it looks like it might be pretty good news. But again, it was, in many ways completely blindsided people, albeit for the better. Perhaps they might consider it to be for the better. But again, it's very hard to have a sight of what might be going on the ground in China with domestic policy at any given time. And that seems to have become even cloudier in recent years, which might be affecting companies' thinking.
Yeah, in the article as well, I quote some recent research as well from Oxford Analytica, which seems to point that business leaders themselves are far more worried about the political risk in the Asia Pacific region, largely linked to China's sort of ambitions. That seems to have increased dramatically in recent times, and so a lot of the production that we've talked about hasn't necessarily been reshored to the US and the UK. Some of it has, but it's been nearshored, to use the buzzword, to economies such as Vietnam and India that are more in keeping with the Western political stance and are considered much lower risk than China. So yeah, there is that geopolitical consideration. Well, investors should look at that as geopolitics as a major consideration now when they're looking to gain exposure to China. I mean, hopefully all this will blow over and China's internal market will, the Beijing measures will drive that consumer market forward, which will underpin the economy. And there's other reasons as well why they're doing it. It isn't really good for any economy to run, trade surpluses on that level for years on end. Even Germany suffers from this. But that was the main point of the article anyway, is just to highlight that geopolitical risk.
Yeah, it's definitely something investors will be keeping their eyes on. And the reopening as well, as I said, it could be a big theme for this year, or certainly for the next 6-12 months in terms of its effects on various sectors. We will be keeping tabs on those ourselves, of course, and you can find much more information on all the topics we've discussed today on the website, in the magazine, as usual. But that does bring us to the end of the show, so thank you to Mark and to Julian, to Alex and to Val and to John. We will see you next time on another Companies and Markets show.